pretty summer flowers have certainly quit growing, but we haven't killed the bud. So normally our first frost date is Halloween, 10/31, and although sometimes we've gone lately past Thanksgiving without a killing frost. So here we sit. We desperately need moisture in Kansas. The wheat crop has been dusted in. They need a couple of rains right here to get it set up to go over, to winter over. Hard red winter wheat is probably one of the hardiest plants out there. 5 or 6 rains at just the right time can give you a good crop, even when moisture is deficient. And it can handle, because it was imported from Russia, brought over with Russian immigrants, it can handle really, really cold winters, especially if there's some snow cover. So the drought in Texas, Oklahoma, Kansas continues. That's the major production of hard red winter wheat. And the reason that you pay attention to hard red winter wheat is that it's people food. It's not cattle or animal food. And if countries don't get, especially in the Middle East, wheat for bread, then dictators can be overthrown. And we have a lot of instability in the Middle East right now. So hard red winter wheat in the forecast for next year's production could be more in play than it normally is. In the United States, who cares? We export half the crop. And the United States is probably more interested in soft wheat because that's what cakes and muffins are made out of. So anyway, the drought continues. That will keep beef prices higher than normal, and prices for bread higher than normal around the globe. Okay, we left yesterday's market wanting to sell. We had the aggressive sell based on what the E-mini would do in the 11 to 15 area, but the preferred sell was 19 to 23, and we were able to get into our preferred sell zone. We're dealing with a P overnight. I think we have one sell left in us. Got a pretty clean ledge here at 12 to 14, so 12 to 14. This little low volume number right here. Then basically 6 to 8. So if we can't crack the 12 to 14 level, I would take myself out. The sell is 19 to 23. The sell is leaning against these single prints right here. And you can see usually the first time into single prints they hold. And you kind of lean against that 50% retracement of the single print. So it gives you a good trade. So it is the end of the week, almost the end of the month. The big dynamic we'll face today is short covering, today and Monday. Obama gave a speech yesterday pointing to all the progress that we've had in the U.S.'s economy and how it was saved from disaster, and Europe needs to do the same. So next week's G20 meeting and meeting of the EU will have more import than it normally does, and reactions out of Greece, Spain, Italy over the weekend will be taken into account. But Germany is flashing warning signs. You know, the only thing that has really been put up is 440 billion euros, 2 to 4 times leverage means we're borrowing money. Borrowing money is what got us in trouble in the first place. So you're going to get articles on both sides. The most conservative approach to the problem is coming out of Northern Europe. The most aggressive, loosest, use the most leverage you can, kick the can down the road, is coming out of France and its southern neighbors. And because Germany and the northern members have the checkbook, they probably win. The problem is that the problems are almost unsolvable. It's how big it is. And if Europe can't pony up $3 trillion, and they won't, then the southern, the pigs nations are in for some pretty tough times, including, perhaps tier 2 euro currency. So it's just I mean, for a group of countries that can't defend themselves, and don't have the will to defend themselves, over time, they get eaten by the wolves that pour out of the woods. So we'll see what happens, but a lot of rhetoric, a lot of talk is coming out of DC and the European capitals, and we'll see if that solves the problem. My guess is it probably doesn't. So we have one sell, 19s to 23s, and then we got a bust 12 to 14 to stick with the trade. Now, if the European debt problem is truly solved, then the focus will go back on economic growth, earnings per share, etc. So the cross currents that we have facing us, well, as traders, it gives us a lot of opportunity. We'll have extra volatility. Okay, you have 1, 2, 3 outside-in trades. And what's an outside-in trade? This is this room's contribution to a 2 lines crossing approach to the market. You're just basically selling the value area high and buying the value area low. And for those of you that live in Europe and points farther east, I mean, this is like taking candy from the babies. I mean, these markets trade technically, and they honor these points. Now, when you get into the day session, you've got to add news, and we are the dog, we're not the tail, and then you have to, the direction of the E-mini, how it reacts to that. But everything on this one is slowly notching higher, so getting short in this 19 to 23 area right up here to see if we can break 14 to 12 is, I think, the trade. And if we can't, then we can trade from the long side. 4,600 on the positive side. Yesterday, a little more activity in calls and puts in both the 10-year and 30. And you see very, very large institutions. If it's used as insurance, they'll collar the market. There'll be long calls and long puts, and they do their thing in the middle. And this is just a cost of doing business for them. They can't lose big money. And they can buy these options relatively cheaply at the start of each month. They usually, from an insurance standpoint, they use the DECE, the March, the June, the SEP contract months to set up their insurance trades. But you can see that this in the note right now, on the note, it's 28 to 31 starting the month. This is the range. Between this range, they're going to let the market go, those that insure, and they've got it buttoned up at 31 and they've got it buttoned up at 28. And anything in between is business as usual for them. So I believe one of the fellows in the room yesterday, I believe Gordon, a visitor, says, is it okay to buy calls and buy puts outside the current trading range and just have at it? Yes, it's a great strategy, and a lot of institutions use that strategy. In that way, they don't get their heads handed to them. They don't have catastrophic losses. The retail account is just new to the game, getting into trading doesn't understand what catastrophic losses can do to their bottom line, and it's that catastrophic loss or that trade that has your name on it that takes you out of the game. And when you first get in the game as a retail trader, you're more concerned about your ego with a little e than you are about your bottom line or trading results, and you just hate to be wrong, to be wrong, to be wrong. And you turn small manageable losses into big losses. And when you look at your first year of trading, there's probably 5 or 6 trades that if you could have just taken normal losses, you'd have been profitable at the end of the year. And no one appreciates this, but it's the magnitude of your losses that determines your bottom line. It's not the percentage of winners. It's not the average gain on your winning side that does it. It's how much money do you keep yourself from losing. Okay, looking at this market in the broadest of strokes, there's yesterday's low in this 61 area. So this single print right here, 58 to 61, is pretty solid support. The dynamic we face in this is long liquidation from traders and hedge funds. From your large institutional mutual funds, trust departments, etc., they don't have any incentive to sell. They like it right here. So the dynamics from hedge funds and short-term traders, long liquidation is what we have to deal with. And that's, if we open weak and trade lower, that's probably when we're going to see the bulk of it. Then if the large institutions don't join in the selling, we'll probably come back into the range. We've got an attractor here at 67. We have an attractor here at 82. So structurally, maybe 85 plus for the top side, maybe 65 minus for the downside, and we work to fill in the market between these price points, excuse me, right in this area, and you can already see that they've started doing that up here. So the buy area, the 65 to 67, is probably our best buy area. Then we've got this volume that we have to deal with in the 70 area. So this is where I'd like to get long. If 70 plus or minus holds, it'll force the issue. And then you got to get back through 75 quickly to stay with the trade. So I see a pause day, consolidation day. We were up 300 on the Dow yesterday. Asia's up, playing catch up. Europe's off. I'd imagine we're going to probe and see where support is. First move in this this morning, then we'll pick it up from there. Okay, the news. Personal income is forecast at +3. Personal spending at +0.6. If this comes in, it means people are borrowing or spending their savings as opposed to living off their increases in income. And that can come from 2 reasons. One, desperation, they have to do it. And the other one is that they're very optimistic about the future, and they're willing to let go a little bit with the idea that they're not going to be fired and that the economy is going to grow and that they'll be able to pay that back over time. And the jury's out on that right now. I think the most prestigious outfit out there, ECRI, says we are headed into a recession. There's not a thing we can do about it. Our government and the Fed, through the Fed, says that we're looking at slow growth. So we'll see what it is. So this 65, 67, 85 area is where I'd be most interested in fading the market, but we may have a decision to make at 70. Now, if John Popick were going to trade this thing, Charlie, lower highs, why would you even think about buying it? and that's the conflict of time frames. The overnight session has definitely been sold. Europe was sold. Selling came in London. So we are looking at lower highs. And directionally on this screen, lower highs generally yield lower lows. Selling against this green line because of what's come before it is a reasonable trade. And if you look at our trades coming down, there's 1, 2, 3 setback trades. We come in, we get an M pattern right here, an RTF or M. Market breaks, comes back up, mean green trade, setback trade to retest this low, and this low holds. So they managed to get stops below 75. We've got this low down here at 73.50. So my guess is they can probably go a little bit lower, and we'll see some support in this 70, 71 area. And we may have to take a long right there depending on how it turns out. 745 is nothing. It means the large institutions probably weren't in the market last night. They weren't in the market with any effect. And you can see right now we got a little bit more on the buy side than we do on the sell side. So there's a possibility that this 73, 75 area could hold. But knowing the way the mindset of this market works, they know there's stops below 73.50, so we have a shot to get down to 70. Well, Germany would really like to issue Weimar D-marks to pay for their southern members. The United States is putting themselves in that position. Some of the early reports on yesterday's 7-year auction was that 55% of that stayed in the dealers' hands. Now, the dealers don't have a whole lot of exposure to that. I mean, if they don't sell it, it goes back to the Fed, and when you look at the Fed balance sheet, you can see that over the summer, at least half of the issues have come back to the Fed in 1 to 3 months. And that could be part of the operation twist that we see right now. Okay, the note is at 22.5, 16 held. Looks like I think the E-mini is going to get a little selling. So we have made a new high. We're waiting for a retest failure before we get busy over there. And that would suggest that the E-mini's got a little selling to come. Any questions? Let's go get them later.